What if the most financially responsible decision you ever made turned out to be one of the most expensive mistakes of your life? That question sounds dramatic, but for thousands of UK pensioners every single year, it is the quiet truth hiding behind a perfectly ordinary phone call to their pension provider. If this kind of information matters to you, do 3 things right now before you forget. Hit the like button so more people find this. Subscribe so you never miss a video like this one. And share this with someone you know who is retired or approaching retirement, because the person this trap catches most often is not careless. They are careful. They are sensible. And that is exactly why they never see it coming. Let us start at the beginning, because the story here matters as much as the numbers. Picture a man in his late 60s. He spent decades as an engineer. He paid off his mortgage years ago. He has no debt. He lives within his means. His car is finally given up and he needs a replacement. He visits a dealership. The salesman puts a finance deal in front of him, something around 7% interest over 4 years. The man shakes his head politely. He does not borrow money for cars. He never has. He's not about to start now. So he picks up his phone and calls his pension provider. He has a pot he has been saving into since the 90s. He's going to take out £40,000, pay the dealer in full, and walk away debt-free. Clean, simple, responsible. And here's the thing. In almost every other area of his financial life, that instinct would have been exactly right. But not here. Not with a pension, not in the UK tax system as it currently works. What follows that phone call is not a small inconvenience. For many people in his position, it is a tax bill that runs to 8, 12, sometimes £15,000 or more on a car they thought was costing them 40. Let me explain why, and I want to be very clear from the start. I'm not a financial advisor. I'm not giving you personal financial advice. What I am doing is explaining a mechanism that is poorly understood and rarely explained, so that you walk into any decision with your eyes open. For your specific numbers, you need either a qualified independent financial advisor or a free PensionWise session, which is government-backed and completely impartial. Now let us get into the mechanics. There are 2 very different kinds of money in most retired people's lives, and the difference between them is what makes this trap so dangerous. The first kind is money you have already paid tax on. Your ISA, your savings account, your current account. When you earned that money, HMRC took its share at the time. What landed in your account was yours, clean. Spend it on a car, spend it on a holiday, spend it on whatever you like. Nothing further happens. The tax bill was settled on the day you earned it. The second kind of money is your pension pot. And this is where everything changes. Every pound that went into your pension, whether that was through your employer scheme or a self-invested personal pension, was sheltered from tax at the time. HMRC gave you relief on the way in. The deal was never that the tax disappears. The deal was that you pay it later when you draw the money out. Your pension pot does not contain your money in the way your bank account contains your money. It contains a deferred tax liability. Every single pound you withdraw lands on your tax return as ordinary income, the same category as a salary, stacking on top of everything else you are already receiving that year. And that is where the number that matters most in 2026 comes in. The full new state pension this year is $12,548. The personal allowance, which is the amount you can receive before you pay any income tax at all, is £12,500. The gap between them is £22. Read that again. £22. What that means in practice is this. If you receive the full state pension, your entire personal allowance is effectively gone before you have touched your pension pot. Every pound you withdraw from that pot is a taxable pound. Every last one of them. From the very first penny at a minimum of 20%. Now add a workplace pension on top of that. Even a modest one of $10,000 or $15,000 a year. And you were already a basic rate taxpayer before you even looked at the pension pot. Let us look at what this actually means with real numbers, because this is where it becomes impossible to ignore. Take someone we will call David. He is 68. He's a retired engineer. He draws a defined benefit pension of $18,000 a year and the full state pension of $12,548. That gives him a total income of £30,548 a year. After his personal allowance, his taxable income sits at around £17,978. He pays roughly $3,600 a year in income tax at the basic rate. He still has about $19,700 of his basic rate band left before he would reach the higher rate threshold, which this year sits at £50,270. His car breaks down. He wants a £40,000 SUV. Perfectly reasonable. He calls his pension provider. Under the standard method for a one-off pension withdrawal, something called an uncrystallized fund pension lump sum, or UFPLS, 25% of what you take out is tax-free. The remaining 75% is added to your income for that year as ordinary taxable income. So from his £40,000, $10,000 comes out free of tax. The other $30,000 is added to his income for that year. His total income is now £60,548. He has crossed the higher rate threshold by just over £10,000. Of the £30,000 taxable portion, the first $19,722 fills the rest of his basic rate band at 20%. That is £3,944 in tax. The remaining $10,278 sits above the threshold and is taxed at 40%. That is a further £4,111. Total income tax on the pension withdrawal, just over £8,000. Now remember why he made that call. He was trying to avoid a finance deal at around 7% over 4 years. That would have cost him roughly £6,700 in interest over the life of the agreement. He paid over £8,000 to HMRC in a single month to avoid it. The debt-free choice cost him more than the debt. The careful choice was the expensive one. But wait, because there is a second problem that hits before the tax bill even arrives. When you make a first or one-off withdrawal from your pension, your provider very often has no current tax code from HMRC for you. This is completely normal. It happens all the time. So they apply what is called an emergency tax code. And the way that emergency code works is genuinely shocking the first time you see it. It assumes you will receive that same payment every single month for an entire year. So if you ask for £40,000 in one go, the system treats it as if you are earning nearly £500,000 a year and taxes you accordingly. David asked for £40,000 and received just over $28,000. He needed to find the rest to pay the dealer that week. He was not the victim of a mistake. The system worked exactly as it is supposed to. He can reclaim the overpayment using a form called P55 on the government website, and HMRC will typically process it within 30 days. But he needed the money then. HMRC has refunded more than £1.6 billion to pensioners caught by exactly this situation since 2015. The average refund in early 2026 was over £3,000. That is not a niche problem. That is a systemic one. The way to avoid it is simple, and almost nobody tells you before it happens. Make a small token withdrawal first, perhaps a few £100s, which prompts HMRC to issue a correct tax code before the main sum leaves. One conversation, one small step, potentially thousands of pounds saved. And there is a third consequence from that first withdrawal that most people never hear about until it is too late. The moment you take the first pound of taxable pension income from a defined contribution pot, you permanently trigger something called the Money Purchase Annual Allowance. Your annual allowance for future pension contributions drops from £60,000 a year to $10,000, permanently. You cannot undo it. If you're fully retired with no plans to ever contribute again, this may not affect you at all. But if you're doing any part-time work, or if you were planning to top up your pension in a year when you have more flexibility, that is a permanent, invisible cost sitting quietly in the background. And nobody mentioned it at the dealership. Nobody mentioned it at the pension platform. It just happens. That is the version of this trap that catches the average retiree. But there are two more. One costs considerably more, and the other arrives from a completely different direction. Now would be a good time to pause and think. If you have found this useful so far, here is a small challenge. Screenshot this video right now and send it to one person in your life who is planning to buy a car in the next year or two and has a pension pot. You do not have to explain it. Just send it. It might save them more than you know. And while you are at it, make sure you are subscribed, because the next video in this series goes even deeper. Let us talk about the version that costs the most. There's a group of retired people, typically former senior professionals or directors, who receive combined income of £85,000 to £95,000 a year. They are comfortable. They are not extravagant. And they are sitting, often without knowing it, just below one of the most aggressively designed thresholds in the entire UK tax code. Above £100,000 of adjusted net income, HMRC begins to withdraw the personal allowance. For every £2 you earn over that level, £1 of your allowance disappears. It is gone entirely at £125,140. The result is an effective marginal tax rate of 60% on every single pound inside that band. Not 40, 60. The standard higher rate applies to the income itself, and a further 20% arrives through the back doors. The vanishing allowance is itself taxed at the basic rate. This has been in the tax code since 2012. It is deliberate, it is known, and it catches people every single year who did not know it existed. Take someone with existing income of £80,000 or £8,000, a defined benefit pension, the state pension, some investment returns. They decide to draw £40,000 from their pension pot to buy a car. £10,000 comes out tax-free. £30,000 is added to their taxable income. Their total income is now £118,000. Of the £30,000 taxable element, the first £12,000 carries them up to the £100,000 threshold and is taxed at 40%. That is £4,800. The remaining £18,000 sits inside the 60% band. That is a further £10,800. Total income tax on the 40,000 pension withdrawal, £15,600. They were trying to avoid a finance deal at 7 or 8%. They ended up paying an effective rate of 39% on every pound drawn to avoid it. And the tragedy is that nobody sat down with them before they made the call and asked one simple question. What is your total income this year going to be before you touch the pension? Because the answer to that question changes everything. Now let us come to the version I find the most troubling of all, because it operates at the opposite end of the income scale, and the consequences are in some ways even more damaging. Picture a single woman in her mid-70s. She receives a state pension below the full rate because she had years out of paid work caring for family. Her total income sits below the pension credit guarantee level, which in 2026 is around £238 a week. So she receives pension credit to top it up. And here is what most people do not realize about pension credit. It is not just a small income top-up. It is a passport. It unlocks a collection of other entitlements that together can be worth £3,000 to £5,000 a year or more. Council tax reduction, often covering the entire bill, free NHS dental treatment, the warm home discount, which takes £150 off the electricity bill, and for anyone over 75, the free television license. She also has an old workplace pension pot, about £30,000 left over from an employer she worked for 25 years ago. She has never touched it. The money has been sitting there quietly. She needs a car. She draws £8,000 from the pot. $2,000 comes out tax-free. $6,000 is added to her assessed income. Her income now rises above the pension credit threshold. Pension credit can be affected. And when pension credit falls away, the passport benefits can fall with it. The direct income tax on £6,000 of basic rate income is modest, a few £100s. But the council tax she now has to pay in full, the dental bills she now covers herself, the lost warm home discount, the television license, those losses combined can easily be 3 or 4 times the tax itself. And here is the painful part. If she had a cash ISA, or even just money sitting in an ordinary savings account, that money would have funded the same car without any of this. Post-tax savings are not income. They do not appear on a pension credit assessment. They do not affect any of these entitlements. The pension pot was simply the wrong place to look. And nobody explained the difference before she made the call. This is exactly what PensionWise exists for. Free appointments, government-backed, completely impartial. Before the withdrawal, not after. There are 2 smaller things worth naming before we move on, because they are both part of the same running total, that people never see until they add everything up. If one spouse is claiming the marriage allowance, which is worth £251 a year in tax saving, a pension withdrawal that pushes the recipient into higher rate tax collapses that claim for the entire year, and the personal savings allowance, which is the amount of savings interest you can receive without paying tax, halves from £1,000 to $500 the moment you enter the higher rate band. If you have a substantial amount of cash earning 4 or 5%, that difference adds up meaningfully over time. Both of these are real costs. Both arrive quietly. Both are part of the same invisible bill. So what do you actually do? The first thing to consider is financing the vehicle. I know exactly how that sounds. To a generation that was taught that debt is the enemy and paying cash is the measure of a sensible person. But run the numbers honestly. A personal loan or hire purchase deal at 7 or 8% over 3 to 4 years will cost roughly £6,000 to £8,000 in interest over the life of the agreement. Set that against $8,000, $12,000, or $15,000 in income tax on a lump sum withdrawal. The interest is the cheapest tax management you will ever buy. You're not paying interest because you cannot afford the car. You are buying time to draw the pension the right way. The second option is to draw the pension slowly, £8,000 to £10,000 a year over 4 or 5 years, each withdrawal staying inside the basic rate band. Park each year's sum in a cash ISA as it arrives. Use a short-term finance arrangement to own the car today and service it from the staged drawdown over time. The total tax across 5 years at the basic rate is a fraction of what 1 year at the higher rate would cost. And the third option, which should always be the first question you ask, is whether there is a cash ISA or any post-tax savings at all that you could use instead. ISA withdrawals produce no taxable income. They do not appear on a tax return. They do not affect the personal allowance. They do not register on a pension credit assessment. They do not trigger the money purchase annual allowance. If there is any flexibility at all in where the money comes from, start there every time. The pension is not the problem. The problem is drawing from it in the wrong way, at the wrong moment, in a single unplanned lump sum, to satisfy an instinct that the tax code has quietly made very expensive. Before any large pension withdrawal, take 10 minutes and do this one thing. Write down every income source you expect this tax year. Your state pension, your workplace pension, any rental income, any savings interest. Add it all up. Then check where that total sits against 3 numbers. 12,570. That is the personal allowance. 50,270. That is the higher rate threshold. 100,000. That is where the personal allowance begins to be withdrawn. Knowing where you stand before you make the call is 10 minutes of work. What it can save you is considerably more than that. If you're making a first or one-off withdrawal from your pension, ask your provider one question before the main sum leaves. Will you be applying an emergency tax code to this payment? And is there a small withdrawal I can make first to get a correct code from HMRC? That question, asked at the right moment, prevents the overpayment, the waiting, and the reclaim form that comes after it. For your specific numbers, please speak to a qualified independent financial advisor or book a free PensionWise appointment. Those conversations are impartial, they are confidential, and they are exactly designed for decisions like this one. Here's what I want you to carry away from this video because it matters more than any of the numbers. The people caught by this trap are almost always the careful ones. In the UK tax system, the most expensive withdrawal mistakes do not come from reckless people. They come from people who paid off the mortgage, who built the pension patiently over decades, who never borrowed when they could help it, who lived by the principle that debt is bad and cash is king. That instinct was right for most of their lives. It served them well. But the rules shifted around it in ways that nobody at the dealership and nobody at the pension platform has any obvious reason to explain. Not because anyone is being dishonest, simply because it is not their job to tell you what your phone call is about to cost. The trap is not the car. The trap is the assumption that a pension pot works like a bank account. It does not. It never did. And understanding that one distinction, clearly and before you pick up the phone, is what separates the people who pay the right amount from the people who pay far more than they ever needed to. You have worked your whole life to build something. The least it deserves is a few minutes of thought before you touch it. If this video has changed how you think about pension withdrawals, I want to ask you to do something. Not just like or subscribe, though both of those genuinely help this channel reach more people who need it. I want you to leave a comment below answering this question honestly. Before today, did you know that taking money from your pension pot to buy a car could push you into a higher tax band? Yes or no? Because I want to understand how many people are walking into this blind, and if you are one of them, it is not your fault. But it is something you now have the power to change.